Okay, so very good morning, Friday the 8th of June. Let's just have a quick recap of what's going on for this morning and the day ahead. And a bit of a negative start to proceedings following on from generally a lower trade on Wall Street, creeping over, feeding into sentiment overnight in Asia Pac, and consequently the DAX future Eurostoxx just on the back foot this morning. Just looking in the center left chart here, the DAX just having broken through where we were in the futures, the low print from yesterday, which was around its respective S1 on Thursday's session. So on the downside, coming down to today's S1 in the futures market, we've got the low print from the 29th and then the kind of initial blip low that we had on the 31st down below. If we would continue in that price pattern, which would put us back down to really monthly lows if that was the case for the DAX. If we did test that area today, it comes after a kind of a rejection from yesterday's session of quite a key technical resistance level, kind of here, that recent double top if you like, but you can see here from what we had circled up from what we were watching yesterday, that kind of mid-May level did carry some significance, and it continues to do so. And since then we've kind of had a decent pullback to the downside. US markets, the equity futures already seeing a little bit of downside movement as Europe steps in. So the S&P just close to a retest of the initial dip that we had just after the European cash close. US futures continued to push down before the eventual bounce came into the close, but we're back down to those levels at the moment. Just looking at the S&P, obviously it's been a decent week overall. I mean, although it feels a little negative this morning, I think you do have to look in context. We were at really the beginning of the week trading around 27, 29. We have got all the way up to kind of 27.80, and so a little bit taken up off the top here makes a bit of sense. Not really a great deal of fresh news to get your teeth into to think that we're going to have a big sell-off today, but there obviously is a real key risk, which is that G7 meeting, which we'll have a look at in a second. But on the downside, quite a nice, I guess, area of a band of support in the S&P that you've got between really in this area here, given the previous highs that were seen in the prior day session. So kind of looking at that cluster of price activity there before the eventual break, you've had the test there kind of defining the up and lower bound of that kind of area of potential support. And again, just looking at any pullbacks as, I guess, the same view to be maintained, that if we did break through there and we saw a run lower, there's obviously a couple of points that you'd be looking at on the descent, but finding areas of where you think that the market could go to in advance of time as to then when could be good entry points is kind of the key, just planning ahead. That would be obviously a little bit more aggressive, a little bit more conservative if you were coming in down at 27, 47, 3/4 here. That's a pretty decent sized pullback though, so obviously you need to reevaluate conditions at that given point in time as to the reasons and the speed of the move down toward that level as to whether or not that strategy would still be viable for a long kind of entry. The G7, of course, as I said, is going to be probably key to whether or not that might materialize. Elsewhere, with the equity markets a little soft, fixed income futures on the front foot. The Bund, decent recovery from some of the hawkishness movement that we saw early in the week. The Bund's up about 90 ticks this morning. Did also get over quite a large amount of supply. That was fixed income issuance coming out of the French and Spanish Treasury yesterday. And so T-notes also up about 4 ticks as well, with some of the general risk off trade. I'll have a look actually, just looking at the charts here from last night. I was actually out of the office yesterday afternoon. It's pretty big pop there in the US 10-year, around 637 last night. I'll see if there's anything behind that as I continue to catch up with things. But let's just get straight into the headlines then. A couple of things to be aware of. You've got the German industrial production, came out this morning. Just follows some weaker data we had yesterday out of Germany, so it continues to paint a similar picture. Industrial output came in at -1% month on month. Expectations were for plus 0.3%. A couple of market commentators, ING being one, saying that German industry's bad news keeps coming as output declines. They're talking about this morning's macro data suggests the German economy has had more trouble re-accelerating than previously thought. So obviously markets are quite fixated at the moment in Europe on not just European politics, which is kind of, if anything, being a more kind of negative bias for the euro currency, but now it's kind of what are the ECB going to do. The recent focus has been on policy tightening, of a live debate of when to end QE. But obviously if we start to see weakness materialise in the likes of the German economy, it's kind of the beating heart of European economic growth, if you like, then certainly that could alter the validity, if you like, of the speed of tightening. And so maybe that's just getting a little bit of a look in this morning. French industrial production also slipping in the month of April as well. And so these would be data points of which the ECB members would much rather be seeing persistent growth. A lot of these numbers, the PMIs, the actual hard data, had been exceptionally strong, and if anything it's just about weakening when they're just about to signal the end of QE. On that note, let me just bring into shot here, if we go to this one. So just on the theme of the ECB, I did send this out to you, a couple of interesting infographics just in preparation of the upcoming meeting, because Bloomberg have done their latest kind of survey of economists. What do they think about what the ECB are going to do going forward? And a couple of interesting charts to have a look at. This is the first one. This is looking at the milestones of the ECB's path towards monetary policy normalization. So this is talking about the QE end date set, forward guidance on asset purchases starts to change, and then notably when we then in the sequence here, which was set by the precedents of the Fed, that you kind of finish QE first, then you start hiking rates, then you start kind of quantitative tightening. Remember, the ECB are way behind in that chain of events, so they're still the firm belief here is that they're gonna wind down QE, deposit rate hike. So that one that's minus 0.4% at the moment in Europe, that's not going to go up until Q2 of next year. So it's going to be a long time before we start talking about ECB rate rises. QE is the dominant topic. How are the ECB going to phase out their net purchases? This is kind of what most economists in the latest survey suggest will be the pattern. And so remember, it's all about kind of subtle forward guidance as to prepare the market for these changes. It's not like the ECB are going to just come out in the next meeting and go, we're going to stop QE, and it stops. It's a lot more gradual than that. And so what they will do potentially this month or next is give the hint as to what's going to happen then from really September. And the belief then is that these purchases, which have scaled down from 80 to 60 to 30, where we are currently since the beginning of the year, is going to tail down to 15, then 12.5, then 10 before the end of the year when it then finishes. So again, you wean the market off of its stimulus in a gradual fashion. What could be the risks to the euro area outlook? I thought this was quite interesting to see the kind of general broader big banks' perception of what's seen as the most high-risk events to the economic outlook in the euro area on the left compared to what's seen as most low risk. Well, the most low risk actually is seen as a geopolitical conflict, despite all the kind of protectionist stance pushed by the US and how that's kind of flared up a lot of foreign politics. That's seen as actually the lowest risk in geopolitical conflict. The actual most highest risk in the near term, understandably so probably, is Italy and political uncertainty. Trade conflict is kind of the next straight after that. So rate hikes, again, just in fitting with the sequence, the usual pattern here that people are expecting from the ECB would be the deposit rate, which is negative, comes up first before the refi rate, which is essentially zero, starts to move up higher in tandem. So again, not commencing, according to most people's belief, until Q2 of 2019. One thing not to rule out, there is, I mean, check that out, there is 2% of the respondents reckon you're going to get a rate hike this month from the ECB. I think those people are crazy, but hey, they're worth monitoring. That nothing is impossible, but obviously you've got to go on the probability and the balance of what most people are expecting. The consensus here is not going to happen for a number of months, certainly after QE is completely finished in that respect. All right, other overnight news. You've had China. They've had their trade data. Just to give you the kind of headline reading here. Trade balance 24.9 billion in dollar terms. That's a slightly smaller surplus than expected. Exports 12.6% higher than expected. Imports 26% higher than expected, 18.8%. I would say overall this Chinese data is not really having an influence on the market open this morning, but just to make you aware of the situation, China's massive trade surplus with the world shrunk in May. So as I said, the overall figure is lower, certainly than was expected and previous. But unfortunately for ongoing tensions with President Trump, the surplus with the US didn't. So there's quite an interesting comment here from Credit Agricole. And so China's surplus basically with the US continues. It's equal to the total surplus in May. The optics of heavy reliance on US market for surplus generation will be a negative in the context of ongoing trade negotiations and could harden the US's stance and thus reduce odds of a deal, as according to Credit Agricole. So again, China being heavily reliant on the exporting of goods to the US means that it's quite a difficult one to respond in such an aggressive way to Donald Trump, and is probably likelihood then explaining why China's been fairly passive in this process, and if anything continue to make gradual concessions to the US, because you've got to remember that China still now and for the foreseeable future is heavily reliant on a good trade relationship with the US, just as it is vice versa. But as far as market moving this morning, I'd say this is kind of lower down the pecking order. One other thing then that was course of a key subject matter for yesterday was Theresa May. Let's just have a quick look at the pound. If I just switch over my charts. And a couple of pointers I think here for sterling. I mean, if we look at yesterday's price action, if I just kind of look at the bulk of the session, at least of which the UK and Europe were trading, I mean, looking at this price movement, the kind of initial swing lower, the bounce back down, a test again, back up, and then net, if you kind of remove yesterday's session, we're about exactly where we were prior to that session beginning. So, if you X out the noise from the number of headlines we had with the kind of rumour mill and full flow of David Davis potentially resigning, that not being the case, then the deputy foreign policy minister under Boris Johnson then talking about we could have a second referendum on the final deal, and then so on and so forth. So, yeah, I think the key here is when it's like that, with any trade strategy, you've got to weigh up the first point of call, the fundamental situation, the fundamental analysis, and then looking at the technical side of the analysis. And so the technicals might have looked fairly interesting yesterday at certain given points as the moves were kind of materializing. However, the fundamental picture is so clouded. There really is no certainty over the situation, particularly with politicians. Unlike generally central bankers who go to great pains as to be very cautious and guarded with the delivery of their communication, politicians can say one thing at 9 AM, it can be the complete opposite by 10 AM, and then they can do full roundabout turn by midday, then the whole thing breaks down by the end of the day. So it was particularly, I think, messy yesterday, and if you were new, you could get a little bit caught up into just trying to trade the news, maybe getting caught out, getting yourself feeling of frustration, fear of then, well, now I'm in a negative position, and the consequences that that can have psychologically. So, you've got to pick and choose your battles a little bit. And I think one of the main points that we were discussing yesterday was about just think about the bigger picture here. Start thinking about, well, what if he David Davis did resign. So then start playing out the scenarios. Well, what if Theresa May, an immediate vote of no confidence was called? I.e., how many actual Tory members would it equate to call that action? So if you hear this 48 kind of tabled, and then you have a fear that she's going to, there'll be a vote of no confidence, she will leave, which is a trigger point then for potentially, new general elections in the autumn, these sorts of things. Try to look at these outer lying scenarios for then which could create a more larger directional move that could then be tradable. So it's kind of trying to not get so caught up in the short-term noise, I think, would be quite key. The other thing I'd say with this matter is for the rest of today, this is by no means over. And just because David Davis and Theresa May seem to have gritted their teeth and come to some kind of compromise, if you like, and solution for the near term, the whole point here is that not a lot really has changed, and this border issue and the customs union is still a real massive sticking point. So if we got new rumours about his resignation again today or something along those lines, it would be absolutely, I think, not surprising. So I think you definitely need to keep an ear out on this subject matter for the rest of today. Twitter can be particularly useful, so if you've got your tweet deck, obviously the people like Laura Kunsberg, who's the BBC political correspondent, Faisal Islam of Sky News, if you go through, you could probably pick up quite a few today, which could be good for getting ahead of the traditional news outlets like things like Bloomberg and Reuters, which typically are quite slow actually at breaking these types of political stories. Also, we've just had a new YouGov poll come out this morning, and just so you're aware, if we did have a new general election, that is a potential for this year, then the YouGov national poll that's come out this morning puts the Conservatives at the biggest lead since the actual general election of last year. So if you thought Labour were making some headway with the mismanagement of Brexit from Theresa May and the Conservative Party, well, actually, Conservatives are polling at about 44, Labour at 37, which is a +2 swing back to the Tories' favour out of Labour. So it's certainly not a done deal. Certainly the election would happen in the first place, but then that Labour would make any headway. But let's face it, polls are polls, and we know that they aren't to be trusted entirely. So yeah, keeping an eye on cable. Well, let's just have a quick look at cable and what could be potential ranges to have a look at, I guess, from a more technical point of view. So let's broaden this chart out. That level yesterday, you can see here, still got kind of marked up. I think it's still a pretty decent floor in the short-term price activity. Maybe a little less solid than it might have been because of we did get a bit chopped up through that point, through the US opening hours. But still, I'd say this 134 handle around there could be quite interesting. So where we are, pretty much that's bounced for the intraday low. Any breach below that point, I guess kind of just scaling this move back down. You've got the initial pop low from yesterday, which corresponds quite nicely with the S1, and then probably coming back down to those late May highs. So just again, marking up your charts this morning, just going through, picking out some points of interest is kind of the more prudent planning thing to do. Just looking at these trend lines here, going from this morning, from the high from yesterday down. So yeah, things to keep an eye on. And I think, yeah, as I said, it's quite a fluid situation on the Brexit side. And yesterday was the first time we saw it spark into a bit of life after it had taken a bit of a back seat. So maybe things still to watch going forward. Another thing, oil. This is the headlines this morning, just to get you up to speed with what the latest is. Oil wobbles near $66 as OPEC mixed views deepen supply dilemma. Now, I just wanted to go over where the latest state of play is at the moment. So Bernstein, and actually quite a lot of the market shares a similar view, and I know Piers definitely thinks the same, is that the actual OPEC meeting happening on the 22nd of June could potentially end in failure. By this, what it means is that actually they cannot come to a compromise. They actually feel as though as the meeting comes, although Saudi and Russia in step with the request from the US have been suggesting that we could have a supply increase up to the tune of 1 million, other countries, certainly Iran, always comes to loggerheads with Saudi at these events, but now we've had the Iraqi oil minister tell Reuters that an increase won't be on the table at the meeting. Now, Iraq have always been very vehement as to not really being receptive to cutting of production, chiefly down to the disruption that the Islamic State has had on the country over recent years has meant that fiscally the country is in kind of dire straits, and obviously they're the third largest producer of crude oil in the Gulf region. Actually they're the second largest, excuse me, behind Saudi, and so they're heavily reliant on the income generated from the sale of oil. To give you an idea, this is an infographic showing you in the black box the current guidance for the level of compliance that's necessary from each of the respective countries in regards to the existing framework of the supply cut deal. So for Saudi Arabia, they have to cut 486,000 in order to be 100% compliant. But as you can see, they're going above and beyond, as are Venezuela. But Venezuela obviously is really through no kind of conscious choice of their own. Their political breakdown that they're experiencing, their kind of internal turmoil in their country has meant that their production has dropped substantially. But if you look here, Iraq is the one single OPEC country that has always been and still remains the one that is got nowhere near being compliant, i.e. they're still pumping more crude than they should be. But obviously these other countries more than make up for that shortfall. So again, the OPEC meeting, I think if we look back at the oil chart, and if I just go back to a daily, this is the chart I had marked up for the week ahead, and potential for consolidation as market monitors OPEC related commentary was kind of my suggestion at the very beginning of the week. And I think this is exactly what's kind of played out. I think the market is fairly comfortable with the state of play of where we are with this potential threat of a supply increase, which would obviously be a net negative. So this was the fall that we had and the technical break of that trend line. And now I think we're just going to hold this pattern. And probably you can bump that line up here to that low that we found back at the beginning of this week. And that consolidation phase could even become even tighter now between a 64 and a 66.5 kind of handle until that meeting happens on the 22nd, barring any unexpected kind of geopolitical events that could shake up the supply side of the argument. One thing is to be sure of, though, when it comes to OPEC, even if they do fail to make a deal and a compromise later on in the month, don't kid yourself, that doesn't mean that Saudi and Russia just won't go ahead and do it anyway. Hence is the nature of OPEC, the influence of those bigger hitting members. So OPEC, Saudi, non-OPEC, Russia, history tells us they tend to, irrespective of an agreement at OPEC, go ahead and do whatever they please anyway. So hence the question marks and the legitimacy of the OPEC group in its entirety. All right, so that's the kind of the setup for the news and what's been coming out. Let me just bring up my charts again so I can go through the calendar of things to come. Just give me 1 second. So, economic calendar for today is particularly quiet. If you're trading the CAD currency, there is something quite interesting to look out for at 1:30. You've got the latest jobs data. But from a US perspective, wholesale sales, wholesale inventory revisions, ECRI data, this is all really of no consequence, I'd say, for certainly Fed thinking for next week. And so our attention turns very much to the trade situation. But remember, the G7, so this is the actual G7 website, and where this is happening in Quebec means that there is obviously a time lag, so the bulk of this meeting is not really going to kick off London time until much later on into the afternoon, to be aware of. I did post into the chat room the full agenda for today, so they're about, well, they are 5 hours behind, so you're looking at 4:45 really for this all to start kicking off, which is the official welcome of the G7 leaders. And really, they don't even get underway for the G7 working lunch, which is about economic growth that works for everyone. Certainly, I mean, the title of that theme is kind of wishful thinking when you think about the current context of the US and the kind of reception Trump is likely to get from people like Macron and Merkel and May and so on and so forth. I saw a couple of memes yesterday about Shinzo Abe and Trump kind of suggesting they should get a room because the bromance that's going on there is pretty immense. But you know, if you've got to understand the politics here, Japan is probably the least affected on the trade situation comparative to the other 5 members of that G7. What's top on Abe's list is protection from the US military over the Korean situation. You know, that's why he's so buddy-buddy with Trump, more so than those other counterparts that comprise of the G7. The others, though, are of a collective view that trade is very much top of the agenda. So if you're looking for flash comments that come out of that, it might not really come until much later on. So if the guys in Trading Live, you might be able to get a piece of the action later this evening. But actually, probably it's going to happen. This meeting goes through the whole kind of Saturday is the real main day, really, when they'll release the communique at the end. So Monday morning is going to be key for the outcome of that meeting, is the reality, really, of this situation. Any leaks, though, rumours, things like that, Trump tweeting on his way to the meeting, all are plausible things that could meaningfully move the market and will need to be monitored. But overall, obviously, markets are a little bit of a risk-off tone. Just seeing some headlines this morning where, if I just quickly flick over and I'll show you, this is quite interesting because the gap between Italian and German bond yields is widening again. So Italian government bonds are under a bit of pressure, and a key measure of investor concern over the attractiveness of debt is climbing. So basically that bond spread, which had been tightening, it's just rewinding again. So maybe a little bit of Italian political risk coming back into the fray. We've had a really well bid equity market, so maybe a bit of profit taking might materialize as well. No one's going to really want to think about it from an investor's point of view. Are you really going to want to carry any risk into the weekend, given the risk of the G7 and the potential flare-up in the breakdown of dialogue on this trade situation with Trump there with all the other major leaders? So given the good run-up we've had in equity markets, do you just book those profits today and you see a bit of a correction on what's more profit-taking move than anything with a fundamental change, because people want to just close and cover those positions going into the weekend given that risk event? Could possibly be a way that this session might play out. All right, leave it at that. Let you guys crack on. Otherwise, I'll see you in the chat room, and if I don't speak to you before then, have a fantastic weekend.